Hi, I'm Nancy Pav with Century 21 Redwood Realty, and I'm here with Anthony Barr of Main Street Home Loans.
Hi, Nancy.
And we are doing part 2 of our 4-part series, and today we're talking about FHA loans. Tell me a little bit about FHA loans. How did they get started?
FHA loan was created by the government back in the 1930s. After the Great Recession, or Great Depression, I should say, it wasn't very easy to get loans like they are nowadays, right? So FHA came about and they allow buyers to get into a loan with as little as 3.5% down. Okay, so the minimum down payment for an FHA loan is 3.5% of the sales price.
Okay, fantastic. And how about closing costs? Can the seller pay any of the buyer's closing costs?
Absolutely. Up to 6% is the maximum allowed by FHA.
So in the last video, we talked about the fact that on a VA loan, the seller could pay some of the buyer's debts.
Mm-hmm.
Can that be done on an FHA loan?
No.
Okay, great. And what about mortgage insurance premiums?
Mm-hmm.
Does that go away at any point in time?
No. So first of all, FHA has two different mortgage insurance premiums. One is an upfront mortgage insurance that is 1.75% of the loan amount, and that's rolled into the mortgage, right? So they calculate that and they add it to the loan amount. The second part is a monthly mortgage insurance, which is called MIP. Okay, that's a monthly payment based on a percentage of the loan amount. Okay, now that mortgage insurance varies depending on your down payment. So if you put 10% or more, that factor changes and the mortgage insurance is cheaper. Now, if you are doing a loan with less than 10% down, the mortgage insurance does not go away for the life of the loan. If you put 10% down or more, that goes away in 11 years.
Okay, fantastic. And FHA loans are assumable, is that correct?
Absolutely. That's one of the great features. You can be in a high rate environment and the buyer and the seller can have an FHA loan with a low interest rate, and the buyer can inquire about that and they can assume, they can take over that low interest rate loan.
Now, is that something that you do?
Yeah.
Okay, fantastic.
Well, not something that we do particularly, but the buyer will contact the current lender that is holding the loan, and they will have to apply to that lender directly and just go ahead and assume the loan from that perspective.
Okay, great. All right. Thanks for watching. If you have any questions, our contact information is below.